Hello everyone, welcome to the 68th episode of me learning how to trade in Forex. So in the last video we went through how to use oscillators to warn you of the end of a trend. We went through what oscillators are. So oscillators work on the premise that as momentum begins to slow, fewer buyers if an uptrend or fewer sellers in a downtrend are willing to trade at the current price. So change in momentum is often a signal that current trend is weakening, which means there's going to be a reversal soon. We found out that sometimes the oscillators don't always agree with each other. So for example in here, one indicator is giving you a sell signal, one indicator is giving you a buy signal, the other indicator is not giving you any signal at all. So just be cautious of that. Yeah. So, and now we're on how to use MACD or moving average convergence divergence to confirm a trend. So let's get started. How to use MACD to confirm a trend. And date is the 8th. So, how do we spot a trend? The indicators that can do so have already been identified as MACD and moving averages. Yep, these indicators will spot trends once they've been established at the expense of delayed entry. The bright side is that there's a less chance of being wrong. So, the graph here on GBP USD's daily chart above, we've put on the 10 exponential moving average, which is the blue line, and 20 exponential moving average, which is the red line, and the moving average convergence divergence. So these two lines are the blue and red 10 or 20 exponential moving averages, and this one here is the moving average convergence divergence. Around October the 15th, so somewhere around here, the 10 exponential moving averages crossed above the 20 exponential moving averages. So the blue line crossed above the red line here, which is a bullish crossover. Similarly, the MACD made an upward crossover and gave a buy signal. Yep, if you jumped in on a long trade back then, you would have enjoyed that nice uptrend that followed. Later on, both the moving averages and the MACD gave a couple of sell signals. So got a sell here and a sell here, both downtrends later on. And judging from the strong downtrends that occurred, taking those short trades would have given huge profits. We can see those dollar signs flashing in your eyes. Now let's look at another chart so you can see how these crossover signals can sometimes give false signals. We like to call them fake outs. Right, so on March the 15th, which is here, the moving average convergence divergence made a bullish crossover, whilst the moving averages gave no signal whatsoever, so there's no crossover here. If you acted on that buy signal from the MACD, you just suffered a fake out, buddy. Similarly, because there's a downtrend happening later, similarly the MACD's buy signal at the end of May, so here, wasn't accompanied by any moving average crossover, but there was an actual upward trend though. If you entered a long trade right then and there, you might have set yourself up for a loss since the price dipped a bit after that. Bummer. But to be fair, there was a it did go up after that one, and here it says to buy. The trend did actually go up later, so I don't know if that counts or contributes towards anything. Summary: leading and lagging indicators. So summary, leading and lagging indicators. Date, it's the same date. What am I doing? So many Forex traders use technical indicators as part of their technical analysis toolbox. We've gone through the two types of technical indicators based on the timing of the signals they provide. Here's a quick recap of what we discussed in the previous lessons. There are two types of indicators, leading and lagging. A leading indicator or an oscillator gives a signal before a new trend or reversal occurs. So a leading indicator gives a signal, or an oscillator gives a signal before the new trend or reversal occurs. A lagging indicator or trend following indicator gives a signal after the trend has started. Leading indicators. Leading indicators are typically oscillators. Yep, they are considered leading because these indicators give you a signal before the potential trend reversal actually occurs. An advantage of leading indicators is that they put you into a potential reversal early. The disadvantage is that oscillators provide many false signals. So leading indicators can put you into a reversal early. However, they give out many false signals. Leading indicators don't make good standalone tools. You should combine leading indicators with other tools such as the Japanese candlestick patterns, classics chart patterns, and support and resistance. Leading indicators should be combined with other tools such as Japanese candlestick patterns, and supports and resistance. If you're able to identify the type of market you are trading in, you can pinpoint which indicators could provide helpful signals and which ones are worthless and to ignore. Which indicators can provide helpful signals? Popular leading indicators are the stochastic, the relative strength index, Williams percentage R, and the momentum indicator. Popular indicators are the stochastics, the relative, just call it RSI, Williams percentage R, and the momentum indicator. Right, okay, lagging indicators. Lagging indicators, also known as trend following or trend confirming indicators. Trading signals of the lagging indicators come after the event has occurred on the chart. A disadvantage of lagging indicators is that they put you in the trade fairly late. This means that you will typically miss a relative big part of the price move. But it's safer though, isn't it? Because you actually do know that the trend has actually happened. Lagging indicators put you into the trade fairly late. Popular lagging indicators are popular lagging indicators popular leading indicators. Lagging indicators are moving averages, so simple and exponential. Weighted as well. parabolic SAR, and the moving average MACD. So how do you figure out when to use oscillators or trend following indicators, or both? That's another $1,000,000 question. After all, we know they don't always work in tandem. We'll give you $1,000,000 real soon. Really soon. Oh wait, we meant the $1,000,000 answer. For now, just know that once you're able to identify the type of market you're trading in, you will then know which indicators will give accurate signals and which ones are the worthless at the time. Once you're able to identify the market trading, you will know which indicators give accurate results. This is no piece of cake, but it's a skill you'll slowly improve upon as your experience grows. Besides, you're not at it alone. In the futures sections, we're going to teach you how to correctly identify the Forex market environment you are trading into. Better use these indicators. A leading indicator gives a signal before, lagging indicator gives after. Yep. Quiz time. Oscillators and momentum indicators. Gauging the strength of trends and potential exhaustion points in price action are important, and oscillators and momentum indicators can help. In trading, what is the MACD? So moving average, convergence, divergence. Correct. This technical indicator is a tool that's used to identify moving averages that are indicating a new trend, whether it's bullish or bearish. If you're working with a good set of oscillators, so that's the leading indicators, you're guaranteed to always get in on profitable trades. That's hogwash. Whilst being aware of why a leading indicator may be wrong, there's no way to avoid them. If you're getting mixed signals, you're better off doing nothing than taking the best guess. Which among the following is not a leading indicator? Moving averages. Popular leading indicators are the stochastic, the relative strength index, Williams percentage R, and the momentum indicator. The Keltner channel helps identify overbought and oversold signals relative to a moving average, especially when the trend is flat. When using Keltner channels as a dynamic support resistance, the price usually hangs around the bottom half of the channel during this is a downtrend. The channel top typically holds as a dynamic resistance, whilst the channel bottom serves as a dynamic support. In the downtrend, price action usually hangs around the bottom half of the channel, finding resistance at the middle line and support at the bottom line. What is the primary advantage of lagging indicators over leading indicators? Less vulnerable to fakeouts. Unlike leading indicators, lagging indicators aren't as prone to bogus signals. Lagging indicators only give signals after price changes, clearly forming a trend. When it comes to evaluating the strength of a trend, the ADX, or average directional index, right? Average directional index, yep, is a popular technical indicator for this purpose. What does ADX stand for? The average directional index. There we go. The average directional index, or ADX for short, is another example of an oscillator. ADX fluctuates from 0 to 100, with readings below 20 indicating a weak trend and readings above 50 signaling a strong trend. Is another oscillator. So this is a leading indicator then. It's best to always use leading and lagging indicators to support each other before opening any trades. Now they're bound to have some conflicts. Whilst the two can be supportive of each other, they're more likely to conflict with each other. A something indicator gives you a signal before the new trend or reversal occurs to help you profit by predicting what prices will do next, a leading. A leading indicator gives you a signal before the new trend or reversal occurs to help you profit by predicting what prices will do next. Leading indicators typically work by measuring how overbought or oversold something is. One indicator that can help us determine where a trend might be ending is a parabolic SAR. What does the SAR and the parabolic SAR stand for? Stops and reversals. One indicator that can help us determine where a trend might be ending is a parabolic SAR, stop and reversal. A parabolic SAR places dots or points on a chart that indicates potential reversal in price movements. Which type of indicator will be best used during trending markets? Trending markets. Lagging, right? It's best to use lagging indicators during trending markets. What is used to calculate the stochastic indicator? Stochastics is made up moving averages, aren't they? Oh no. Stochastic is based on the high-low range of the time period. In this case, it's hourly. Yet it doesn't account for the changes from one hour to the next. Alright, so it's a high-low range. Leading indicators are also known as oscillators. Correct, leading indicators are also known as oscillators. Right, okay. What is an oscillator? A measure of price volatility levels, a button in your spanking new smartphone that tells you running late, a measure of extreme relative value of price. Stats, isn't it? Oscillators measure momentum and are designed to show when an asset is potentially overbought or oversold. The relative strength index is a popular indicator that helps traders evaluate the strength of the current market. What does the RSI stand for? Relative strength index. Relative strength index, or RSI, is a popular indicator developed by a technical analyst named J. Wells Wilder that helps traders evaluate the strength of a current market. Which of these indicators uses the change from one closing price to the next? That's a stochastic. No. Oh, it's the relative strength index. What? I thought it was the stochastics. Oh no, that's a high-low range. Oh right, it's the relative strength index. Right, okay. Which type of indicator will be best used during sideways markets? Leading, right? It's best to use leading indicators during sideways markets. Lagging indicators are also known as trend following. Lagging indicators are also known as trend following indicators. When using oscillators, what does a change in momentum often indicate? The current trend is weakening. A change in momentum is often a signal that the current trend is weakening. Which among the following is not a lagging indicator? MACD. No. Oh, it's not lagging. Oh, right. I thought it says leading. Right. What, is that still wrong though, isn't it? Oh no. Popular lagging indicators are moving averages, simple exponential weighted, parabolic stop and reversal, and the moving average convergence divergence. Lagging indicators spot trends once they've been established, but at expense of what? No vulnerable fake. What? Often the biggest gains of trends during occurs in the first few bars, so by using a lagging you could potentially miss out on much of the profit, and that sucks. What? I thought the question was oh no, maybe not then. Okay, on to the next. How to trade chart patterns. How to trade chart patterns. By now you have an arsenal of weapons to use when you battle the markets. In this lesson you will yet another weapon. You will add yet another weapon. Chart patterns. Think of chart patterns as a landmine detector, because once you finish this lesson you will be able to spot explosions on the charts before they even happen, potentially making you a lot of money in the process. Chart patterns are like that funny feeling you get in your tummy right before you let a fart explode. Nice. Don't you wish you had a chart to detect this explosion? Nice. In this lesson you will learn classic chart patterns and formations. When correctly identified, it usually leads to an explosive breakout, so watch out. Remember, our goal is to spot big movements before they happen so that we can ride them out and rake in the cash. After all, who doesn't want to have a pool of cash to swim in, like Richie Rich? Chart formations will greatly help us spot conditions where the price is ready to break out in a certain direction. They can also indicate whether the price will continue in its current trend direction or reverse, so we'll also be devising some nifty trade strategies for these chart patterns. In a nutshell, chart patterns help you answer 3 questions. How do I find potential entry points in a rising or falling trend? So chart patterns help traders find potential entry points in a rising or falling trend, offer potential entry signals, show when to, I can't think of the word, when to get out, either to take profit or cut losses. Don't worry, we'll give you a neat little cheat sheet to help you remember all these cool patterns and strategies. Here's a list of chart patterns that we're going to cover: double top and double bottom, head and shoulders and inverse head and shoulders, rising and falling wedges, bullish and bearish rectangles, bullish and bearish and bullish pennants, triangles, symmetrical ascending and descending. Nice. How to trade double tops and double bottoms. When a double top or double bottom chart pattern appears, a trend reversal has begun. So when a double top or double bottom chart pattern appears, a trend reversal has begun. Learn how to identify these chart patterns and trade them. Double top. A double top is a reversal pattern that is formed after there is an extended move up. Double top is a reversal pattern formed after there is an extended move up. The tops are peaks that are formed when the price hits a certain level that can't be broken. The double top is a reversal pattern that is formed after an extended move up. The tops are peaks that are formed when the price hits a certain level and can't be broken. So like the resistance level then. Tops are peaks which are formed when the price hits a certain level that can't be broken. After hitting this level, the price will bounce off it slightly, but then return back to test the level again. After price hits this top, it will bounce off it slightly, but then return back to test the level again. If the price bounces off of that level again, then you have a double top. If price bounces off that level again, it's a double top. So one top, two top. In the chart above, you can see that two peaks or tops were formed after the strong move up. So strong move up, one peak, two peak. Notice how the second top was not able to break the high of the first top. This is a strong sign that reversal is going to occur because it is telling us that the buying pressure is just about finished. With the double top, we would place our entry order below the neckline because we are anticipating the reversal of an uptrend. With a double top, place entry order below the neckline because we are anticipating a reversal of the uptrend. Let's get a photo of this. Wow, we must be a psychic or something, because we always seemed right to be right. So place an entry order below, so place an order here, and then boom. Looking at the chart, you can see that the price breaks the neckline and makes a nice move down. Remember that double tops are a trend reversal formation, so you want to look for these after there is a strong uptrend. Look for it after a strong uptrend. You also notice that the drop is approximately the same height as the double top formation. So this length here is going to pretty much the same as this length here. Keep that in mind, because that will be useful in setting profit targets. Drop is approximately the same height as the double top formation. Double bottom. The double bottom is also a trend reversal formation, but this time we're looking to go long instead of short. So double bottom is basically the opposite of double top. Double bottom is a reversal pattern formed after there is an extended move down. Look for it after a strong downtrend. These formations occur after an extended downtrend when two valleys or bottoms have been formed. Valleys are peaks which are formed when the price hits a certain level that can't be broken. After price hits this valley, it will bounce off it slightly, but then return back to test the level again. If price bounces off that level again, it's a double bottom. With a double bottom, place entry order above the neckline, because we are anticipating a reversal of the downtrend. So we can see from the chart above that after the previous downtrend, the price formed two valleys because it was unable to go below a certain level. Notice how the second bottom wasn't able to significantly break the first bottom. This is a sign that the selling pressure is about to be finished and that reversal is about to occur. Will you look at that? The price broke the neckline and made a nice move up. See how the price jumped by almost the same height as that of the double bottom formation? Remember, just like double tops, double bottoms are also trend reversal formations. You want to look for these after a strong downtrend. Climb is the same height as the double bottom formation. Cool. Next lesson. How to trade the head and shoulders pattern. The head and shoulders chart pattern is a reversal pattern that and most often seen in uptrends. Head and shoulders chart pattern is a reversal pattern. Most often seen in uptrends. Not only is head and shoulders known for trend reversals, but is also known for dandruff reversals as well. Okay. In this lesson, we'll stick to talking about trend reversals and leave the topic of dandruff for another time. Head and shoulders. A head and shoulders pattern is also a trend reversal formation. It is formed by a peak shoulder followed by a higher peak head and then another lower peak shoulder. Head and shoulders. Shoulders is formed by a peak. So shoulder, higher peak head, lower peak shoulder. The neckline is drawn by connecting the lowest points of the two troughs. Neckline is drawn by connecting the lowest points of the two troughs, aka the lowest points. The slope of this line can either be up or down. Typically when the slope is down, it produces a more reliable signal. So neckline slope can either be up or down. Typically when the slope is down, it produces a more reliable signal. So it looks like that. In this example, we can easily see the head and shoulders pattern. So shoulder, head, shoulder, neckline, so lowest points of the two troughs, lowest point of the two troughs. But then where do you find that lowest point? Because why not use this point here? Or why not use this point here? In this example, we can easily see the head and shoulders pattern. The head is the second peak and is the highest point in pattern. The two shoulders are also formed peaks but do not exceed the height of the head. With this formation, we put an entry order below the neckline. Put below the neckline. We can also calculate a target by measuring the high point of the head to the neckline. high point of the head to the neckline. So like this distance here. The distance is approximately how far the price will move after it breaks that neckline. Right. Oops. So price moves approximately the distance from head to the neckline. Oh, let's cut that up. Put that there. You can see that once the price goes below the neckline, it makes a move that is at least the size of the distance between the head and the neckline. We know you're thinking to yourself, the price kept moving even after it reached the target. And our response is, don't be greedy. True. Inverse head and shoulders. The name speaks for itself. It's basically head and shoulders formation, except this time it's upside down. A valley is formed, a shoulder followed by even lower valley head and then even another higher valley shoulder. Inverse head and shoulders is the same as the head and shoulders but upside down. Formed by a valley, shoulder, lower valley, head, valley, shoulder. These formations occur after extended downward movements. Occur after extended downward movements. So after a downtrend. Here you can see that this is just like the head and shoulders pattern, but it's flipped upside down. Yep. With this formation, we will place a long entry order above the neckline. So long entry order placed above the neckline. This should be short entry order, just put below the neckline. Our target is calculated just like the head and shoulders pattern. Measure the distance between the head and neckline. That is approximately distance that the price will move after it breaks the neckline. Price moves approximately the distance from the head to the neck line. If your target is hit, then be happy with your profits. True. However, there are trade management techniques where you can lock in some of your profits and still keep your trade open in case the price continues moving your way. You will learn about those later in the course. Isn't that like trailing something that we learned before? Hold on a second, let me just see if it makes sense. Let's take a photo of that. shoulders. Inverse head and shoulders is formed, whoops, by valley, short entry order is placed below the neckline, placed above the neckline, occur after extended noun movements. Extended downward movements. Are formed. Downward movement, long entry order placed above the neckline, price movements approximately in distance from head to the neckline. Boom. Okay. Well, I'm going to leave this episode here. So, thank you for watching. In the next video, we're going to cover how to trade wedge chart patterns. So, yeah. I'll see you guys then. Bye!